1, 2, 1, 2. Teams, teams, teams. I never know when the recording starts. All right, guys. Yeah, well, this is another podcast because these charts, man, that are coming out, the signals that we're getting are more and more historic in nature. You'll see North Star charts, showed some charts, DXY adjusted for inflation, SPX divided by producer price index, and all these charts go on, and the rates of change breaking down, or like everything's shifting from growth to value, commodities, gold, and all that stage was set back in June of 2019. So there's still some pieces of the puzzle to fall in place, like the gold silver ratio has to break down once again. Gold has to actually break out versus the SPX. Um, but when you look at the overall weight of evidence, something special is happening, especially when you look at these 100-year charts, guys. And it's all about your purchasing power getting destroyed. So it's been getting destroyed. Look at this chart, guys. Top left is this is kind of fun because the Fed has its own metric for purchasing power of the consumer dollar. So they have that data since 1914, 13. See, it starts top left here. It's kind of hidden a little bit by the information of the ticker. But top left and down, up, not a new high, sideways, grind, down, up a little bit, down, just going all the way down. So that's what's been happening over 100 years. It's the destruction of your purchasing power. And here you've seen us use the inflation adjusted, so the DXY divided by the producer price index to mimic a purchasing power chart. Because the first time I saw, remember everybody says, oh, that purchasing power, and then you see like the green flag behind it, like a green back. Then they show, oh, this your purchasing power has gone down, since whenever. But then the DXY is just strength versus other currencies. So it's not telling you much, right? Because everything can be going down or up together. But look how well it tracks this. So here's how the Fed measures it. This thin black line here, the golden or orange line, that's the DXY adjusted for PPI. Yes, it goes up and down, but you see how it's using that line as a pivot. Sometimes it's below. That's when you're in a bull era for precious metals, commodities, and then when you're above, then it's for growth stocks, etc. Here's the 2000s, or deep below that line, and now it's turning down. And the best advice I could give you guys when you see these type of like money supply going up over long periods of time, bottom left to top right of a chart, or these destruction of purchasing power, these currencies or purchasing power laws that goes from top left to bottom right, you need to put a rate of change. Rate of change will tell you the volatility, the movement within that line. So even if it's going down, there could be some periods where the relative movement back here, how fast they move from a previous point. So here, my rate of change is 84 months. So that is 7 years of rate of change. And this tells you, and the market prices in rate of change, sudden changes, sudden moves. That's what the market prices in. It has to adapt, right? It has to figure that stuff out. And that's where it creates an edge in your favor. Here from 1919, the purchasing power from this low here, if you have held for 7 years, it was actually going up, guys, above the zero line. So 7-year rate of change where your purchasing power was actually going up. It was possible. It did happen prior to the crash in 2029. But after that, rising trend line, whatever purchasing power people had, to decide for whatever reason, to dilute it, to destroy it, to print more money, etc. So now it dropped sharp, 60-degree angle. But now this is my sleep mode line. It breaks down below that. Then it drops another 60%. Oh boy, has to bounce back up? No. The cycle of destroying your purchasing power is enacted. As soon as you go below the sleep mode line, then below the zero line, now anybody, so in 1935, 6, 7, that means if you would have held those dollars from 7 years ago, you're already negative. That purchasing power that went up here, 7 years later, it's negative, and it just deepens and deepens and deepens and deepens and deepens until you reach a bottom here. It's a new reflation in your purchasing power. But look, it's still the 7 year rate of change is still below zero line. So even as the 7 year rate of change goes up, you'll see that that upper line is still going down. You're not gaining ground on back in, you're never going back to 1913, 1914, guys. Just forget it. You're not even going back to 1929. So this is a lower high after this peak below. So 7 year of change stays negative, and what happens? Create a new topping structure, and you know how it is. Purchasing power, it goes up a little bit, or you feel like it's going up, and then after that, they just find a reason to dilute it once again to buy whatever they want to buy, military wars, whatnots, to just depreciate it. Instead of taxing the people directly, they do it through destruction of purchasing power. So here, 1, 2, 3, 4, 5, really close to the sleep mode line. I could have put it tighter. So that's an angled, pretty aggressive angled. Here's another topping structure. Can't do new highs, breaks down. And this is the cycle, guys, that launch gold, right? So 65, 66, and that thing, as it starts sliding down, gold just rockets and gets repriced, and silver and the miners and all that keeps going up through the 70s, all launched by this topping pattern here. And there's some aggressive waterfalls here, and down and down. And where does gold top? Well, it tops where down here. So when it's over exaggerated, destruction of purchasing power is so much that they have to fight whatever all that inflation that destroyed your purchasing power, or it gets subsided. Remember, like cure for high prices is high prices, and supply comes online. Like all that narrative, all that fundamentals. I'll let you guys figure that out. But that eventually it stops. So now we're at the low water mark. So right now, this is a growth, perfect environment for growth stocks, U.S. equities. There's a reflation of your purchasing power within that, but still below zero, guys. Look at that black line, still going down, and that's the illusion. You think you're gaining 1, 2, 3, 4, 5, 6 touches. It breaks down in 99. After I go sideways a little bit, but the purchasing power is not able to get back to these highs of the pre-70s or even those highs of 1929. And just that small move down, guys, and I'll show you the chart right after that, the real killer. I'll show you details about this. That was a huge bull run. Gold went from 200 to like 1900, 2000 in that span, even as that your purchasing power just went down just that little bit in 7 year of change. So that stopped going down, creating a new sleep mode line, 1, 2, 3, 4, 5. Yeah, and I'll show you in the next chart because there's a line here. You guys might see it, but I didn't see it until I did my next chart, which is going to be slightly different metric. I'll be using a different rate of change. Look at that huge breakdown, huge breakdown. And there's even a horizontal line here I drew later that it closed down below. But I'm noticing the steepness of this rate of change. How fast is it dropping? And this is an error right here, guys. It's not same angle of descent. So now it's going down pretty much at a 53-degree angle. It's more than these two huge slides that we had back in the 70s, which went down at 46% and 40%. I wrote the same angle of descent, but it's not. It's minus 53. And in the 1929s, 1930s, it went down 60% and 60%. Huge acceleration in your purchasing loss power. So that is pretty much what decides where your money is going. If there's a cycle of depreciating your currency, you it's hard stuff that's going to reflect it, right? Anything that falls on your foot that makes noise, copper, gold, all that stuff denominated into this fiat, their nominal price are going to go way up more than the growth assets. People are going to start rotating money out of growth towards these other classes of commodities. So that was stage one. Here is stage two, guys. So this second chart. So this is the rate of change, the 4 year. So instead of the 7 year, I put the 4 year of the purchasing power. Don't see it here, but that's of the US dollar purchasing power, that thin black line that kept going down there I showed you previously. Here, the red line is the zero line. So anything above that, that means if you would have held here, anywhere here, that means if 4 years previously to that point, that's how much percentage you gained on your purchasing power. So up here, even people that held the US dollars back in 1929, they had gained 32% purchasing power from 4 years previously. But that is not to be seen ever since then. After that, that thing dropped below zero line. So all right now, the purchasing power 4 year rate of change is negative, tries to go back above, can't do it, just drops, goes down, goes up, tries to get back above that zero line, that 4 year rate of change, cannot do it. Goes down, creates some lows, starting to define a pivot line, a trend line. Tries to go back one more time, early 60s, late 50s, cannot do it. Now look at that. What happened? Left, top, right, head and shoulders, or topping pattern, getting squeezed. I could have drawn here rising another upward trend line. So here I have like an 18-year base. It breaks down here. After that, it breaks down from the horizontal support right here. That we'll discover later that is an important pivot line. So it's like an area zone here, 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 here. So that line, this early breakdown line is very meaningful. But furthermore, that line, that pivot line, that wall, that previous resistance turns support is broken down of. And you see the momentum that it started going down and just carried it, carried it, carried it, carried it. And we all know what gold and silver and the miners did in the 70s. And that's 1969, this line. It just rocketed. So this 18-year topping structure garnered enough momentum that it just propulsed, propels, propelled gold, silver, miners, etc. Back in those days, uranium, whatever, you name it. And we know that US equities just went sideways unless you had some dividend paying US equities. Even if you held just those and you reinvested those dividends in those US stocks, you would have barely came flat after this long period, guys. And like all runs, and eventually this starts stirring back up, and then that's it. Go long growth stocks. The inflation cycle is done. So just start a new one, and it's climbing, guys. So now it's climbing. It's reacting to this critical pivot line, right? What I call a wall. So previous support and resistance. Oh, it's working it. Gets back above. Retested from above. Now it's support. Now, oh, resistance. Oh, it goes back down, but it wasn't meant to be right now. In 1990, goes back up, and it's trying to climb to that. It wants to try to bring a 4 year rate of change above that zero line, but it cannot do it. It was not able to do it. It came minus 4%. It could not go back above those 1960, 1950, mid 50 highs. So what happens? You run uphill all that time, garner that energy, and then if you can't make it, then you tumble. So look at that. Starting to find that line, that early breakdown line, just like we did here. Here's a test. We don't know it exists yet. Oh, get another test. Okay, I have 2 points. It's on the third point that you know that that line really exists. And after that, oh, here it is right here. It had another test. And then that line morphs into existence. You do a reaction on it. You bounce up. But the destruction of your purchasing power is so powerful that this thing just melts through. It cannot bounce back higher. I drew a whole bunch of other resistance breakdown lines that broke down here. There's one here. There's another angle here. But what struck me massively in this chart is when you look at the SPX divided by the PPI, there's often, you've seen me, there's four of them, right? There's a breakdown in the 30s, there's a breakdown in the 60s, in the late 60s in favor of PPI. There's a breakdown in the 2000 in favor of PPI. But this one, I could have drawn those lines in this chart, but this rate of change encompasses all of the 2000 run. So you see this topping structure here? It is massive. It is 36-year topping structure versus the 18-year topping structure we had that led to the 70s bull era, gold and silver and miners. This one's 36 years, guys. It's huge. So whatever happened in the year 2000 to 2010, 11, gold going from 300 to close to 2000, silver from whatever, $5, $6 to $50. It's in here. This is massive what's happening right now. This thing is broken down from the early breakdown line. It's closed below that final breakdown line. that pivot line, historical, where that's the pivot line that led to the 1970s bull era. It's below that. And when I know that SPX broke down versus PPI confirmed, NASDAQ broke down versus PPI confirmed, this is another huge piece of the puzzle where the momentum is now clearly downwards. And my target is back down here, back to these 1980 lows. This thing is going to run down. It's going to have these moves sideways like that, little waves. But this is enacted, and the bigger the base, the higher in space. That is valid for any type of TA. So all that energy that went from 1980, 1982 all the way to 1922, that 40-year bull era and reflation of your purchasing power, the best it could, and it couldn't even go above the zero line, the 4-year rate of change. So that's how good that was. It couldn't even get back above. It's breaking down now. So it's the guy running up the hill, and he ran out of energy. Now he's just going to tumble down the hill, and that's what's happening right now, guys. And look, it's happening. So eventually, I don't know, 1 month, 2 months, 3 months, gold will break out versus SPX. And I've shown you previous charts where silver tracks that, the miners track that. So we're on the turn, and the turn is happening right before your eyes, guys, right before your eyes. It's not going to be time to get in long when this has run all the way down here and the 4-year rate of change for your purchasing power is rock bottom and people think it's the end of the world. There will be some type of reflation event, just like it happened here in the 1946, all the way back up here. So that's it, guys. The turn is really enacted from that top. And yeah, so governments and central banks have jump-started a destruction cycle that's going to last 10 years, 8, 10 years, easy, of your purchasing power. And you got to be ready for it, guys. All right. Thanks for watching. Ciao, guys. Do, 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 do.